If you're stepping into the world of commercial real estate investing, there's a term you're going to hear over and over, the 1031 exchange. At first, it might sound technical, but once you understand it, you'll realize it's one of the most powerful tools for building long-term wealth and deferring taxes. So, what exactly is a 1031 exchange? It's named after Section 131 of the IRS tax code. This rule allows you to sell one investment property and reinvest the proceeds into another like-kind property without immediately paying capital gains taxes. In simple terms, it lets you keep more of your money working for you. Instead of handing over a large chunk of your profits to the IRS, you roll that gain into a new investment. More money to invest means more potential income and a faster path to growing your portfolio. Let's break down the key rules you need to know if you're thinking about using a 1031 exchange. First, the property must be like-kind. That means both properties must be held for investment or business use. This rule is pretty flexible. For example, you can exchange a warehouse for an office building or a retail space for an apartment complex. Second, the timeline is strict. You have 45 days from the sale of your original property to identify a new one, and 180 days to close on that new deal. Miss these deadlines and you'll owe taxes. Third, you'll need a qualified intermediary, or QI. This is a third party who holds your sale proceeds and facilitates the exchange. You can't touch the money yourself, otherwise it's considered a taxable event. Fourth, title and ownership must remain the same. The same entity that sells the original property must be the one buying the replacement. So, if your LLC sold the first one, your LLC has to purchase the next. Now, why should new investors care? Because it's one of the few legal ways to defer capital gains taxes while upgrading your real estate portfolio. You can trade up to larger or higher income properties, consolidate several smaller properties into one, or even diversify into different types of assets, like moving from retail into industrial. It's a strategic way to grow without constantly losing chunks of your equity to taxes. Let's look at a quick example. Imagine you bought a small retail space for $400,000 and sold it for $600,000. Normally, you'd pay capital gains taxes on that $200,000 profit. But with a 1031 exchange, you reinvest the full amount into a $900,000 multi-tenant flex property, let's say in a booming market like Katy, Texas. You've deferred your taxes, scaled up your portfolio, and boosted your rental income, all in one move. The bottom line? A 1031 exchange isn't just a tax loophole. It's a smart wealth-building strategy that every new investor should consider. With the right planning, it can help you grow your real estate business faster and more efficiently. Thinking about using a 1031 exchange for your next move? Don't go it alone. Get expert guidance to make sure you stay compliant and maximize your returns.